Great, thank you, David, and good afternoon all, and welcome to what is now the fourth of our What ESG Investors Want webinars, and being now hosted during our week of year ahead webinars. The theme for today's session clearly is ESG investing in 2021. What do we think are the key drivers, the key trends that we should be looking out for? And again, as always, the aim of this webinar series is to give you direct, unfiltered views from the buy side, from ESG investor stakeholders. I'm really pleased to have with me in the panel representatives from Franklin Templeton, La Française, and Actiam, and I'll just let them introduce themselves briefly. Gail, over to you, please.
Hi everyone. I sit within the fixed income team at Franklin Templeton in London. I work primarily on ESG integration at the fund level, at the department level, and really just understanding what our different clients want in terms of the push that we get from European clients, and really understanding where our US clients are at the moment, and trying to facilitate and service those clients.
Great, thank you, Marie. Over to you.
Hi everyone, so I'm Marie Lasseigneur. I'm a credit portfolio manager at La Française. I manage portfolios invested in investment grade and high yield globally, with a focus on climate change and the energy transition. And my focus within the team is to look at ESG integration depending on the type of credit strategies, so across sectors and across thematic. Thank you.
Thank you. And Fabian.
Hi, I'm Fabian van der Meij. I'm portfolio manager credit with the fixed income team with Actiam. And I'm focused on corporates, but besides that, I'm also linking pin between the fixed income team and ESG. And also in relation to that, I'm focusing on the sustainable bonds, and also one of the guys who's looking to the assessments of green bonds in general. Back to you, Arthur.
Perfect, thank you. So as David has already mentioned, we will begin with a moderated section. I will be asking the panel questions on three broad topics. One of them is pending ESG reporting standards. The other one is potential new governmental policies. And the final one is expectations for sustainable debt supply next year. Once I've done that, there will be an opportunity for you to indeed ask your questions. And as David has mentioned, welcome both written questions and indeed people raising their hands and asking their question. Beginning with the first topic, clearly we've seen an acceleration in sustainability-focused reporting and drives at product standardization. And arguably some of the most important within Europe have been the EU taxonomy and indeed the green bond standards. And Fabian, I'm very keen to hear your perspective on how those will be impacting your work as a fixed income investor.
Yeah, I think that both are connected, of course. The green bond standards are part also of the EU taxonomy. But if you split them those, I think that the EU taxonomy is more impacting the data gathering. So in the end, we have the obligation, but also like every sustainable investor is now already doing, just measuring how sustainable our investments are. And that means also data gathering. But what we're lacking right now is, I think, a common sense, a common future. We expect that the EU taxonomy will give us that to all the investors, to all the asset managers, and that is very helpful. However, what we're a bit worried about is that it is now, we have already a very long time discussions about it, and it becomes a little bit complex. And just for an asset manager like we, it is also good to have one template, as to say. So, and also for the issuers, I think it is important to know what the figures are they have to deliver. Too much is not always better, as to say. The other one, the green bond standards, I think it is also there good to have harmonization to know what's green, what's social, or what's sustainability. However, we have already a lot of frameworks in place. So I think the added value there is more that you have one standard, and everybody is standing behind. It's clear, but it's also important for regulation going onwards. And just looking to ourselves, we already assess green bonds with our own methodology, but we expect that the green bond standards will give more in-depth criteria to analyze that. Back to you, Arthur.
Certainly, and Fabian, you raise, I think, an important point there around the EU taxonomy and concern that what's vastly becoming a quite dense document now can become potentially quite complex, and some people have argued it can become a little bit too restrictive. And Maria, I would very much welcome your thoughts. Is there a risk that by trying to fight greenwashing, our standards are becoming too narrow and sort of risk impacting sort of market growth?
Thank you, Arthur. Well, I think one main concern, and that was actually quite represented in the EU Green Bond consultation on the standard, was about grandfathering. Because you obviously don't want this standard to be putting off the efforts that have already been put in place with the last couple of years market growth. And I think that's part of the question as well. And here, I think because the criteria and the levels are quite demanding, that the complexity of the overall document is definitely is definitely a concern for everyone. You need to make sure that the issuers that have already proactively built a green curve or sustainable and that have already built their framework should have some kind of eligibility to this new era, the new market that will come. Obviously, there is a line that needs to be drawn somewhere, but I think looking at the assets which are being financed behind those green bonds, like the ones that have been financed already and the future ones under the framework, which are already existing, the standard should allow some of this flexibility. Otherwise, it will put off issuers which have already been quite active in this market. And that's for the grandfathering part, which is, transferring the existing pool of the green bond market into the future green bond market, which is a very important aspect. As per future issuance, yes, we can say that the expectations behind the taxonomy and the green bond standard are high, but they serve the purpose of removing this kind of greenwashing fear in the market, and that needed to be addressed. But the taxonomy will not just have an impact on the green bond standard; it will also be the point of reference for sustainability-linked bonds, which I'm sure we'll talk about later. And here you've got a greater flexibility as a corporate because you will be able to focus not just on projects but also on your overall transformation. So I think the different applications that will cascade from the taxonomy being put in place will allow everyone to find a way to issue under this new standards. Thank you, Arthur. That's
helpful. Thank you, Marie. And I guess a common thread there, but both on your point and indeed in Fabian's point, is around this sort of merits there of having more of a common language, right, from an investor point of view, and then when you're producing your own reports. And I guess, Gil, if you sort of fast forward in the next few years, when we have the EU taxonomy fully embedded, is your sense that your own fund climate reporting will be a lot easier and it will be a lot more aligned?
Yes, I mean, I think it's difficult to imagine that it won't fulfill that function. We are already seeing benefits of using the technical index. I mean, and specifically referencing the kind of industry, kind of the NACE mappings index at the back of the document, where we get such a lot of certainty with regards to emissions for, let's say, cement, or required emissions level per kilowatt hours for, say, electricity producers. And I mean, already we do a lot of engagement around carbon emissions, and to have that level of certainty, it aids our discussion, and because we know that the research behind it has been put together very much with reference to Paris 2050, and the requirement for all of these different industries to bring down their emissions levels to what the index specifies. It really is just about technical certainty, and everything that we've been discussing up until now on a theoretical basis and gearing up towards compliance 2050, bringing down emissions. The technical index is a huge step forward for that, and it just gives a level of a level of certainty, really, to benchmarking where a company is today, and where their ambition for 5 years' time would put them. So I would say, I would definitely say it's hugely helpful with regards to climate impact, and for us has already been so in conversations with companies around where their current emissions levels are. The cement manufacturers was a really good one. We got back some responses to some recent engagement, and emissions per cementitious product were all roughly around the same thing. And we could then compare that with the level that was cited in the technical index, which was roughly, I think, maybe about 40% or 45% lower. And that amount of information, or that amount of research to get ourselves there, would have been probably time consuming to the point of probably not having to outsource it. So we've leaned on it heavily thus far, and I imagine that we'll continue to do so. And it will definitely, it has already started to shape our view on climate impact and where the companies we invest in should be going and are going.
You mentioned there, Gail, I guess the key point there in terms of carbon related reporting and climate change, and while we've been discussing the European frameworks, clearly a framework growing very rapidly in global prominence is TCFD, carbon financial disclosure. I'd be interested, Marie, in your views. Clearly, the UK is set to make this mandatory. How do you think TCFD will evolve next year and thereafter?
Sure. Well, let's not forget that the TCFD origination story is very similar to what we had a couple of years ago with TLAC, which started being non-mandatory and became then a market norm. And you actually, with TCFD, this is from the very beginning, what the optimists were hoping for, and hopefully what is actually happening, because there's not only regulators enforcing TCFD as being mandatory, like in the UK, to listed companies and private companies as well, but there's also the fact that so far the latest progress report shows you that 60% of the 100 biggest corporations have supported or disclosed under the TCFD. And what it means here is that there's going to be a capillarity effect, because those biggest corporations will have levels of expectations of disclosure and measurement towards their suppliers and other stakeholders, which will raise the bar in smaller corporations. And that will have, I guess, a more natural also spread of the TCFD as the standard, because the point here is to create a market level playing understanding of how do we measure, how do we disclose, how do we discuss, and it gives investors and corporates finally this kind of common language, common metrics to talk about climate risk and opportunities, specifically to the sector that the company is actually acting in. And I truly believe, as an investor, a sustainable investor, I believe that actually going through the exercise for a corporate or any kind of company forces you to fully assess and understand the risk you're actually facing with the scenario analysis and the value at risk, etc. And maybe to structure yourself in a different manner in the way that you can better respond to the risks that are coming in 5, 10 or 20 years. So that can only be beneficial and a value creation, a source of value creation. Thanks.
Great, thank you, Marie. And I guess just Gail, for be honest, anything else that you'd like to comment on when it comes to the new wave of ESG reporting coming our way?
I think the biggest or the most obvious area is data. This thing that is a universal struggle that, whether you are trying to produce an impact report or whether you're just simply trying to ask the issuer of a green bond for some updated impact metrics, or finding a common framework or a way to produce an impact report for a green bond fund, or knowing that even the impact metrics that you've reported are the same or done in the same or calculated in the same way that your peers are. I think there are a lot of questions out there with regards to data, and as soon as more companies are accessing a similar or the same thing many more times, we get many more iterations of that data, and by the process of natural improvement, I hope, the optimist in me hopes that data will be the biggest winner in the next few years, because I think that's what we need.
Yeah, from my side, Arthur, I think one phrase, keep it simple. We don't want that issuers are stepping away from the sustainable bond market because it's too complex to deliver all the data. So let's focus on that. Back to you, Arthur.
Great, thank you both, and indeed, I think very valid point. That takes us to the second topic, policies and some of the political developments. And clearly, within Europe, we've seen post-COVID the launch of the Recovery Fund, which of course has besides social a very heavy green recovery emphasis. And of course has a sizable amount of fundraising to do in the coming years. Fabian, I'd welcome your views on how further issuance from that fund, from the SURE fund, will impact the market.
Yeah, yes, Arthur, that's a valid question. Of course, the new recovery funds, it was also this morning news that maybe there will be the setup will be different, that maybe some countries will be out of it. However, but there will be a recovery fund probably, and how it will set up. I think it's already you see it already with the SURE bonds. They were launched after the summer. They were brought to the market. SURE bonds are also from the EU, but then on the social aspect. And the recovery fund will be more related to green, more digitalization activities. And what you see in size, it's you cannot see it anymore as an AC or a supranational. It's that big amount that it is just another sovereign coming to the market. I think it is in size in issuance already the fourth or the fifth after a bigger countries like France and Germany, and that also means that it's also trading differently compared to other supranationals or ACs. So it will impact that market. It will impact the market for ACs, but I don't think it will carve out the other sustainable bonds. So green bond funds will take this in their account, but I think it will be a substitute for a France green bond or the new Germany green bond maybe, but not carving out the corporate green bonds. It's still in place there, also because what I see a lot of green bonds and investors want to see exactly what company, what project, what activity they investing in, and the EU recovery is very necessary and very wonderful, but that is not it is that much different project that it is maybe you don't see the exact projects behind anymore. Back to you, Arthur.
Yeah, that makes sense, Fabian. It's a portfolio approach with a very, very, very big portfolio. I guess moving slightly beyond the European sort of borders and focus, clearly we've seen some, I guess, ESG friendly developments in China with the 2060 net carbon neutral goal. In the US with an administration that seems quite focused on climate change activism. And Gail, I very much welcome your view. How will that sort of growing focus also from China and the US impact ESG investing and just more generally sustainable finance?
I mean, again, I don't want to sound like an unwarranted optimist here, but I think it can only be a positive, only have positive impact. I think, you know, if you look in a kind of analytical way at how much information and ambition and regulation and maybe some of it PR, any kind of airtime coming out of Europe around climate ambition and decarbonization, you know, for the amount of emissions that Europe represents, it really is a outsized amount of discussion that we see coming out of Europe. And I just picture, you know, suddenly USA and China coming to the table. And then can you picture the amount of ambition and the amount of airtime and the amount of regulation and the amount of forward momentum that would be the result of, you know, suddenly there's almost I think there's the expectation of a more favorable environment in US and in China being created in order to kind of propel these decarbonization sectors forward. So, you know, more tax breaks, things like carbon subsidies or not carbon subsidies, carbon taxes. But, you know, industry would be propelled forward in the way that even more so, because I know obviously there's a lot of activity in China that has already happened to date. But, you know, the kind of federal or government level support that Europe has enjoyed, you know, that can only expand to the US and China. And, you know, pending Biden not having his hands tied by, you know, kind of domestic politics, there's suddenly a more competitive corporate landscape. You know, suddenly the market, the whole market, the Chinese market and the US is solving these problems, as opposed to maybe some of that weight, or most of that weight, being bared by Europe in the past. So I think it's going to really drive innovation. I think drive competition. I think it's going to be a very exciting space. You know, just the prospect of cooperation, you know, or just even the prospect of the fact that we might not be all focused on potential war of words and war of taxes anymore. You know, that they can channel their energy into something a bit more productive. I think it's going to be a really exciting area. And, you know, look at Europe in the last 10 to 15 years, a lot of innovation, a lot of progress, and maybe map that onto what essentially is China and Europe. I mean, China and US, their emissions are extraordinarily higher than Europe has ever been. So, yeah, again, very, very positive. Only positive things from me.
That's very welcome in these sort of still gloomy times, Gail. You mentioned taxes, and I think turning to you, Marie, La Française, you published a paper, I think it was in October, where you reflected on the various mechanisms available for green stimulus. Very much welcome your views on that. But what do you think are likely levers that the government will pull to sort of encourage decarbonization?
Sure, Arthur. Well, it goes along what Gail was mentioning about the European history in terms of tackling their ambitions in tackling emissions, because we see that as of today, there's more than $800 billion which have been committed to a green recovery, as called. That's before the US and China, obviously. And most of this comes from Europe so far with the Next Generation EU plan. And obviously the point here is not just about the recovery measure and who's going to benefit from this financing directly. It's also observing how the European Union and the European Central Bank are organizing themselves, their budget, their policies, their mechanism to meet their Green Deal agenda. Because you see that today, 25% of the European budget is tied to the Green Deal. And the Green Deal itself has a busy agenda coming up for 2021 as well. And that includes the carbon border adjustment tax in Europe, which I think is a very relevant topic to keep in mind, because it's so far has failed to reach unanimity in Europe. But there could be ways, mechanism where they wouldn't need unanimous votes, and they could put it forward, which seems to be, I mean, it's chatter, but it seems to be, in a position where it could be done in 2021. And what it would do is that it would favor, it would try to avoid carbon leakage by basically taxing imported goods from outside Europe to make sure that it doesn't create a competitive disadvantage for our European producers. And that's particularly important for, hard to abate type of sectors like cement, steel, aluminum, which represents still almost half of our emissions in Europe, and but who are already more efficient than their peers outside our borders. And that could create, again, by impacting the carbon compliant cost to their competitors and to imports, that could finally favor them, those European players, and finally compensating the cost that has been put in place for the energy transition and for investing in assets that are allowing to decrease emissions to comply with the European rules. So that's very positive for European industrial landscape, because it's could be funding partly the recovery, the green recovery ambitions from Europe. It could economically favor our industrial activity here in Europe, and this would have the greater benefit of encouraging outside EU producers to decrease their emissions, so that they decrease the cost inputted on their imports from Europe. If that's if that's clear. Thanks, Arthur.
Yeah, I think that's a great point, and it's probably one that hasn't had as much airtime as some of the other policy proposals. But I agree, Marie. I think that has a lot of potential. Perhaps for beyond from your side, and anything else in terms of political developments that we should be looking out for as it pertains to ESG?
No, I think that is also important. That what I already mentioned is also related to the different categories. I think it is important not to focus only on green, but also on social, for example. And what we see from the EU and in general, it is now recovery fund is merely focused on green. But what I already said about the short bond, that is more related to COVID and social. So you also see a rapid rise in that category this year, and a lot of ACs and banks are just now issuing those bonds. I think also NatWest and 2019 issued a social bond, but so you have seen an enormous rise there last year or this year. I think that the number is about more than 60-70 billion this year, and compared to last year, it was only maybe 10 billion in euros. So COVID-19 and other reasons is something that's popping up, and therefore social is going to rise. But for the rest, I don't see a lot of issues there. And why is that? Because too much focus, in my opinion, is on green, and therefore also other issuers think it's sexy to only to focus on the green. And I think it is also important on the social aspect, because that is also an important factor in a society to focus on. So I hope that we learn from the current situation and also give more attention to that, and don't forget, and we will not will forget, if we are after this crisis, that we also the social aspect take care in our investments and in a sustainable bond universe. Back to you, Arthur.
Well, thank you, Fabian. I think that's a very good bridge to our third topic for the panel, which is focusing on next year's sustainable finance supply. And I believe one of the panel members already mentioned this early on, but sustainability linked bonds. Clearly, we have the ICMA standards now. We've got a degree of support from the ECB for this product. Gil, from your perspective, how do you think the sustainability linked bond market will develop next year?
And I suppose this is one that we've spoken a lot about. We really like sustainability linked bonds for the reason that they appear to make issuers or push issuers to consider the broader organizational performance and broader ESG goals, broader strategic direction, as where maybe sometimes with green bonds they are projects in isolation, and as long as the projects are suitable and fit into a neat use of proceeds category, then they would qualify as green bonds. The sustainability linked bonds that we've seen, we judge them on the almost like the difference in there would be a quite a aggressive upswing in the rate at which a company is establishing renewable energy capacity. I think it was the recent NL one where the step up was they would pay a coupon if they didn't meet their step up, and the step up was a doubling in the rate at which they had been previously establishing renewable capacity. I mean, it's a big increase. It's not just 30% or 40%, it's doubling. And so we like them for that reason, and for that reason we think that from the corporate side it offers a lot of flexibility. Obviously, it doesn't, as talking to a lot of the corporates, they can structure it in a lot of different ways. As long as they're demonstrating material progress, I think investors will listen. And that's, I think, what the narrative from investors just needs to be is we need to see concrete progress, or we need to see material progress, and we rely on the technical annex for that. And I think with that kind of welcoming environment, what's to stop an organization from seeking to do better in exchange for a preferential rate? I think it seems to make all parties, it seems to satisfy all parties. And the more work we do in ironing out expectations and being transparent about expectations, the easier it will become. So yeah, our expectation is that we're going to see a lot more of them. We would like to see a lot more of them. We always look at them in a lot of detail. We always want to see good progress. We don't just, even if a company says we're just going to carry on doing the wonderful stuff we're doing, sometimes we'll say, actually, you need to do more than that. Unless you are already on target to be decarbonized or net zero by 2050, then that's the trajectory, the incline that they need to be on. So yeah, I would expect we'd see more of them, and the opportunity that they offer to the less mainstream sectors or the less industrial sectors are vast. So we welcome them.
Thank you, and perhaps Marie, turning to you, and I think Gil has articulated very well the merits of SLBs. It's fair to say that there's still a number of parties that are relatively more skeptical when it comes to this instrument vis-a-vis a traditional use of proceeds instrument. What would you look at when sort of assessing an SLB, and I guess what would be your advice to potential issuers to avoid greenwashing accusations?
I think if there are fears or potentially, greenwashing concerns out there, it's because it's exactly what Gail said, is that it could encourage issuance from sectors with high levels of emissions, or sectors where the structural activity makes it hard to identify a project which would be eligible for a green bond. But the overall, and we've had recent examples in the SLB market recently, which, don't get me wrong, is very positive, because it finally gives a format for those sectors where, oil and gas, cement, aluminum, where it would be very hard to find eligible projects, but SLBs would be, suddenly considered. And to the question of greenwashing, I disagree, because I feel like there's no more concern about greenwashing for an SLB than for a green bond. A green bond, yes, we know that we have to identify a project which is eligible under a certain level of the taxonomy, and then you report on it, etc. But here, with the green bonds, you still see examples where the issuer in itself is not complying with the initial intent of use of proceeds allocation, and therefore you find yourself as an investor into a greenwashing situation, because the commitment has been breached. But it's not about what the issuer does, because the function of a green bond is exactly the same as an SLB, is that we want to allocate more money, more financing towards assets which are helping the decarbonization objective, right? There's different ways to do it, because the SLBs focus on the output and not the input. So what is the issuer, overall doing for its sustainable strategy, rather than what are the assets it's investing in? It's really not about, how do you get there, but do you get there really? I mean, with the as an investor, the expectation that they do no significant harm or do not get involved in controversial activities, still holds. But it allows the flexibility of using OPEX, CAPEX, acquisition financing, refinancing, other types of purpose, which, for the reality of things of an issuer, especially smaller issuers, could make more sense. Especially as you go down the high yield universe with smaller and private companies, where your realities make it that you don't have 500 million of capex to spend a year into renewable energy, for instance. I think the format is clear for investors and quite clear to issuers. And again, I'm paraphrasing what Gail said, but it's about the ambition, right? Because the standard from ICMA tells you that you need to show material improvement compared to your business as usual. Material improvement doesn't say much unless there's scrutiny from the investor and expectations that if your SLB is linked to the EU taxonomy, then show me how your level of ambition performs against the Paris Agreement objective in Europe, or the European overall climate neutrality objective. And if you compare yourself with let's say an SBTI approved 1.5 degrees trajectory, then I'm pretty sure no one can argue that you've been trying to greenwash anyone with your sustainability linked bond. So it's all about using the common language and common benchmark. If you're using environmental targets, then give to the market the level of ambitions that you're giving yourself. And I think we now have enough benchmark and enough levels, examples of the expectation of the market to make sure that issuers do not fall into the easy accusation of greenwashing. And then from the investor perspective, it's still about doing the job of challenging the issuer with regards to the KPIs they've chosen as much as possible. And potentially challenging the amount of step up, the penalty, because so far the market is not really deep in the SLB market. So most examples are around a relatively small step up. But again, this market started from investment grade type of issuance, so it's linked also to credit quality. I think this is an area which will need more development potentially. How do you norm this potential penalty? And as an investor, wouldn't you be able to judge the level of ambition of the issuer with, you know, the level of potential penalty it puts itself under? Because supposedly your commitment is something you know you can meet. Therefore, this penalty is not something you should be expecting to pay as an issuer. Whereas if you have a 10 bips or 25 bips step up, is it really a penalty? So I think there hasn't been enough issuance yet to get broad discussions on that topic, but it's clearly something that is, you know, will become more of a central to the discussion for investors. Thank you.
Thank you, Marie. Very helpful perspective. And perhaps for beyond, clearly SLBs are the talk of the town at the moment. And how are views at Actiam developing around this product?
No, I think that we agree both with Marie and Gail on that. I think that maybe good to add is also what we see for sustainable bonds and sustainable linked bonds is that it's also a tool to engage with the issuer. So you normally, when the framework is presented, have more thorough discussions about the plans, the targets, and as an investor, you can really have a discussion with the issuer, and we have seen that there are possibilities that they change their framework because of that in the build-up of a new bond. And that is also what we like for sustainable, but also sustainable linked bonds, is that it has to be the top, as they say. So it has to be an instrument for a sustainable investor to move the market, as to say. So we also would like to see that market is always has more stricter rules. So, and sustainable linked bonds can also help with that, because the whole policy of the company is part of that, and with that you can also address certain topics what was not easy to address, for example, in a green or social bond. For example, if we like to see that issuers or a sector is addressing certain controversies, that is not always had to do with big money putting in that topic. More had to do putting up a certain ambition to tackle that, and it's more changing your policy, and also saying when do you have made that change. So sustainable linked bonds, I think, are very useful on that side. Back to you, Arthur.
Thank you, Fabian. And I think what came across very well across all three of your responses was really the potential of SLBs for a new type of issuers, sectors that perhaps we haven't seen as prominent in the traditional green bond market, and reflecting perhaps a little bit on sectors and supply from different sectors. Gail, I'd very much welcome your views on any particular corporate sectors you'd like to see more supply from next year.
Well, I suppose we always look at our green bond fund in light of, well, in comparison to a similar duration fixed income fund that isn't a green bond fund. And, you know, we do have differences in the amount in the sectors that we invest in. In our green bond fund, I think we've got maybe about 40% sovereigns and then 20% utilities and 20% financials. And it would be great to see that diversified, you know, to the point of where our other fixed income funds are. And we do get the question a lot from clients, and, you know, it's the natural question. It's any sectors beyond, you know, the bulk of where we've seen issuance come from to date. And these are probably the sectors that are not seen as industrials, and maybe do have slightly less to decarbonize, but are still important nonetheless. And then obviously the more materials heavy sectors. I think we've seen a bit of activity from Lafarge recently, and, you know, more from that kind of more from that corner would be lovely. I think anything that would allow us to kind of have the same sector allocation as a regular fixed income fund when we're comparing to the benchmark.
Great. Marie, anything to add there in terms of shout outs for sectors or types of issuers you'd like to see more of?
Well, I would tend to second what Gail just said with regards to expected supply from those higher emission types of sectors, and we know the ones, right? The ones that haven't been participating in that area for a while, but issuers that have already started their transition journey and communicate about the sustainability strategy and have started investing in projects and activities which are a testament of their willingness to achieve those sustainable goals. I think they are definitely eligible now under this format. They're supported by the wider market with the ECB eligibility, and I think to the same extent that the transition bonds concept was trying to address this, we really need them. We need them to come to this market to make sure that there's an overall representation of our economy as investors, as Gail said, to match either benchmark objectives or really to match the reality of things. And we, as investors, we would really welcome more of this deeper industrial issuance that needs to transform.
From your perspective?
Yeah, I both agree with Gail and Marie on that. What I like seeing from a portfolio perspective, of course, more diversification would be useful. Still, green bonds are just dominated by financials and utilities on the corporate side. However, we have to be critical in what type of typical issues are there. The whole oil and gas change movement is there's several issuers are eligible now, I think, also for the green market because of that. But we definitely are not looking for every sector to come to the market because of diversification purpose. It has to fit, and I think that we have seen in the past some less good examples, as to say. So yeah, the credibility of the green bond market is still important, and we prefer to see the better example, the good examples, for example, and maybe less than more issues coming to market with question marks. Thanks, Arthur.
Thank you, and that's the end of the moderated questions from my end. David, do you mind reminding the audience how they can submit their questions?
Yes, thank you, Arthur. Just to remind our audience today, if you'd like to ask a question, you could type this in the Q&A box on the bottom of your screens in Zoom, or if you'd like to use the raise hand function, we'll bring you live into the meeting. You can ask it in person. Back to you, please, Arthur.
Great, thank you, David. A question that's come in here, and this is a concept that a few of the panel members have mentioned, and that's transition bonds. And of course, we saw an example a couple of days ago with SNAM. How does the panel feel about transition bonds and whether it's suitable as sort of a separate standalone asset class? Who would like to come in on that one? I can see Gil first, and then Marie.
I mean, I think it's good that this has received a lot of airtime in the market. It just shows that investors are quite skeptical of the structures and the ambitions that come out. But sometimes the green bond market does, or the kind of green/sustainability market does have they do tend to have like kind of cluster think, I think. And, you know, that just means we kind of latch onto one theory and then everybody agrees with that theory. And in reality, if there is a particular geography or company where, you know, there's where that company operates, if there's an acute environmental risk, you know, pollution risk would be the most obvious one. And if there is a material tactical gain that can be had from investing in legacy infrastructure, then why would we argue with that? I mean, obviously, it's not going to be as long-term impactful as you know, completely carbon-free or emissions-free infrastructure, but in the case of, you know, that infrastructure still having a useful life, and maybe there are certain issues that prevent a full 180 to you know, climate aligned infrastructure, you know, why would we argue with that? It's needs to be considered on a case by case basis, and investors maybe shouldn't be so frightened of the entire investor community ganging up on them and saying, well, all transition bonds are bad, because I just don't think you can have a blanket opinion like that and say all transition bonds are bad.
Yeah, I would tend to agree with that, because the transition bonds, when they started, really had the kind of intent to be of a different shade of what the green bond market was putting at first, and allowing issuers like the SNAM example, because it was one of the first transition bonds to be using gas in there. I think now in the end, the SLB is kind of giving you a way to meet that objective, the initial objective that was intended to with the transition bonds, because it's about where are you getting, you know, more than how do you get there. So I guess, you know, and the transition bond in itself hasn't really picked up, which is a pity, because I'm part of those investors who would rather look at the overall company development strategy and positioning with regards to the lower carbon economy, more so than specific projects. And therefore, I think much more issuers would have been eligible to issue transition bonds. But yeah, it just so happens that it didn't spike that much. And now you can wonder, what's the point of, we can't push every sustainable theme or label. I think we need to, you don't want to have a counteracting effect by pushing transition, pushing sustainability link, pushing green, pushing sustainable as a mix of green and social. I think we need more social and green initiatives, and they could be framed through social bond, green bonds, or sustainability linked bonds. As much as we would welcome new transition issuance, I think now with the sustainability linked model, we might have a way to gather more types of issuance with, you know, the main labels, without multiplying or without cutting this sustainable market even more so, if that makes sense.
It does. Thank you. Fabian, from your perspective, any strong views on transition debt?
I agree also with Marie and earlier on, but I think maybe as example, we also not have a separate transition category within our framework. We see it more as a green bond, as to say. And also, if you, in our opinion, if you test the SNAM bond, it is seen as a green bond in our methodology. So I think it is one of a kind, to say. Back to you, Arthur.
Great, thank you, and thank you very much to the panel. I think we've covered a lot of ground this afternoon. A couple of notes that I've written down. One is the move towards common language and common benchmark that we're starting to see, particularly within Europe. I've noted Marie's comment about TCFD taking a similar trajectory to TLAC in terms of becoming mandatory and hence becoming quite a powerful tool. Take a note as well, Gail, of your comment, the process of natural improvement that we'll hopefully see when it comes to ESG data and indeed ESG issuance. For beyond, I think you've rightly raised the point that social perhaps is not as sexy as green, and that we probably need to be thinking a little bit broader in this market, as we have started doing post-COVID. And then finally, I think we've had a very robust discussion around sustainability-linked bonds and also the merits that they have as a flexible tool, a tool for welcoming in new issuers and probably allowing a level of engagement around corporate strategy for ESG fixed income investors. With that, again, let me thank the panel for a very good discussion. Thank you all for participating. This marks the last What ESG Investor One webinar for this year. Hope you all have a good festive season. Look forward to reconvening in the new year. Thank you all.